In just a few weeks, 36 million Americans applied for unemployment. The unemployment rate reached almost 15%. It might not seem high, but during the 2008 crash, when the world economy collapsed, unemployment peaked at 9.6%. The upcoming crash is closer to the Great Depression of 1929. To understand how we ended up screwing so badly that we are on our way to the greatest financial crisis humanity has ever faced, we have to understand a few things. How does the economic machine works? What role do the central banks play? And what exactly we did wrong? Before we get started, let's address the elephant in the room. When you need some extra cash, what do? You'll probably give a visit to your local bank. But what do the banks do when they don't have the money to lend it to you? They call the central bank, or the Federal Reserve in the United States. The job of the central bank is to protect the currency of that country and grow the economy by controlling the supply of money and, most importantly, keeping inflation in check. If the economy isn't growing, the central bank will lower the interest rates so that borrowing money will be affordable. More people and businesses will borrow to expand, which will stimulate the growth and will get back the economy on its knees. Worst case scenario, the central bank will print trillions of dollars and throw it into the economy as they did back in 2008. If, on the other hand, inflation is rising too fast, the central bank will increase the interest rates where borrowing money will simply be too expensive so that fewer people will borrow and less money will be spent. Therefore, inflation slows down. You probably have heard that whatever rises will definitely fall, and that is the case with the economy. In fact, United States broke the record of the longest economic expansion in its history. The economy has 4 main stages, and it starts with expansion. It peaks somewhere at the top and then plummets, which is also known as contraction. And once it reaches the lowest point, it rises again. During the expansion period, the economy is booming, the stock market is rising, and it seems like the growth will be forever. Interest rates are low and businesses are borrowing and expanding as fast as they can. Investors are throwing money at the stock market and everyone is happy. Unfortunately, it doesn't last forever. At some point, the central bank is going to say, inflation is growing too fast. Let's slow it down. So the central bank or the Fed will increase interest rates to keep the inflation under control. The economy has reached its full potential. It stabilizes and grows just enough to cope with inflation. But investors are used to extraordinary returns. For instance, in the last 10 years, iPhone sales have been increasing, but this year they didn't since the economy isn't growing that fast. That scares off investors and some of them slowly start pulling out their money. Businesses like Apple will do their best to maximize their sales to keep investors interested. However, at some point, the supply will outweigh the demand. There are just so many people who want to buy an iPhone. So businesses will slow down. That will push away investors, which slows down further the market. But businesses have somehow to survive. They will start cutting costs. First, by firing the least important employees. So unemployment starts rising, which means the demand starts falling in the market overall. Businesses can't even take loans since interest rates are too high, since the Fed increased them because inflation was too high. That's how the economy slides into a recession. People start to save since they are afraid and uncertain about the future, which means the demand in the market falls even farther, which means more businesses will suffer, which means more unemployment. It's a never-ending cycle that keeps dragging the economy down. Usually, the Fed intervenes by lowering interest rates to save the economy from the recession, but it doesn't always work instantly, and the economy keeps declining. At some point, the economy is going to reach its bottom line, which is also known as a depression, when the GDP declines by at least 10%, or the recession lasts for more than 2 years. Sooner or later, the Fed is going to say, enough is enough. We are going to rescue the economy at all costs. First, they will lower interest rates to 0 so businesses can borrow money for free. But what if that doesn't help? Well, the European Central Bank dropped the interest rates to negative 0.5%, which means the central bank will pay you to borrow that money. But sometimes even that doesn't help. People are afraid to borrow money because the economy looks so bad that they don't seem to be able to pay it back. In that case, the central bank will head to their bunker and use their nuclear option, which is quantitative easing. That's just a fancy word for printing money. Businesses will take that money and hire people. Investors would see that the economy is slowly recovering and will start investing. The economy will return to the expansion stage, and the same cycle will repeat over and over. Since we know how the economy works now, what exactly are we in this graph? Have we reached the peak, or we are in a recession, or are we still during the expansion period? Well, it's extremely difficult to know for sure since we don't have all the facts in front of us, and there are a lot of factors that can influence the economy. But based on what we know, we can try to predict. One of the best indicators are the interest rates, as we have discussed earlier. We can see that the Fed has increased interest rates from 1% in 2005 to 5.2% by 2008, since the economy was reaching its peak. But then everything collapsed, so the Fed lowered interest rates to 0.25% within a year to stimulate the growth. And for the next 7 years didn't change them, since the economy was at its expansion period. But then in 2015, it started to increase. By 2018, interest rates were at 2.5%, which means we might have reached the peak already. In 2018, something different began to happen. The Fed lowered the interest rates. Other central banks, such as European central banks, began lowering interest rates since 2014. But they were already at 0%, so they lowered them to 0.5% by 2019. Other countries like China also decreased interest rates. What does that mean? The central banks knew that we have already reached the peak and a recession was on the horizon and tried to postpone it as long as possible by lowering interest rates. Even the global GDP growth slowed down year by year. In 2017, it was 3.1%, but in 2019, even before the pandemic, it fell to 2.4%, the lowest growth of the decade. That didn't happen by accident. In the last few years, a lot of things happened that slowed down the economy. First, we had the Brexit, which scattered off investors because the future of EU became unpredictable. But you might say you shouldn't be worried because they can invest in the United States or China, right? But then suddenly the United States started a trade war with China and scared off more investors and slowly dragging the economy into a recession. Even with Brexit and the trade war, we still could somehow postpone the recession. But then COVID-19 looked at our economy and said, "I am about to destroy this man's career." We live in a world where consumption drives the economy forward. The more people earn, the more they spend, the faster the economic machine turns. But right now, even if people are willing to spend, they simply can't because restaurants, malls, barbershops, airlines, offices all have to close down. That's why almost every government in the world is trying to put the money into people's hand so that their spending doesn't fall and the economy does not slide into a depression. However, the problem is that there is just so much money the government can't raise or print. They can't keep distributing money when the economy does not produce anything. Millions of Americans have already applied for unemployment benefits as of April 2020. It's most likely that the virus won't be gone for another few years, and it's very unlikely that we'll have a vaccine by the end of the year. On top of that, since we're most likely already in a recession, if we end up experiencing a second wave of this pandemic, then depression is inevitable. That's one of the main reasons why the current US president, for example, is trying to open the country as soon as possible, since if the country will slide into a depression under his watch, he will most likely lose the election at the end of the year. Whether that's good or bad, it's up to you to decide. By the time this video will be out, the country will probably be open. But not all businesses are going to suffer. Online businesses like Zoom, for example, are growing tremendously. Even Amazon has been growing. But most businesses will be left with two options. They will either change their business and adapt to the new realities by changing their business models, digitalizing their products or services, or go bankrupt. A lot of businesses will definitely won't make it. But as they say, every crisis presents an opportunity. Many new businesses will take their place. This pandemic is literally pushing the world to go online completely. It's difficult to say what will happen in the future since almost all predictions turn out to be wrong. But based on what we know today, we are most likely going to a depression. The economy together with the stock market will crash. If you guys have enjoyed this video, make sure to give it a thumbs up, and if you want more similar videos, let me know in the comments below and hit the subscribe button. Thanks for watching, and until next time.